In 2011, Fukushima catastrophe changed the nuclear story. Multiple countries, including Germany and Japan, pulled back from nuclear power. What followed was a decade-long retreat. For years, nuclear looked politically toxic and economically difficult, but that is not the world we are in now. Now the trend is turning the other way. This is not really a story about nuclear power. It is a story about a fuel market that most investors barely watch. A market where utilities cannot afford to run out. A market where most buying happens in private contracts. And a market where new supply can take years to arrive. That market is uranium, and right now, the signal is not hype. Long-term pricing is still firm, utilities are still recontracting, and supply still looks slow to respond. So the real question is not whether uranium is hot. The real question is, which mining companies are best positioned to gain most from this trend? Before the stock names, one quick point: the uranium market does not work like oil, copper, or gold. Most uranium is sold through private, multi-year contracts between utilities and suppliers. That is why uranium always seems to have two prices. There is the spot price, which gets the headlines, and there is the long-term price, which matters much more for planning, contracting, and financing new supply. At the end of April 2026, Cameco's published industry average series showed uranium spot at $86.35 per pound and the long-term price at $91.50. That distinction matters because uranium equities can behave differently from the headline commodity chart. Spot can move fast, but miners often realize prices more slowly because contracts can be fixed, lagged, formula-based, or capped. So if you want to understand the real uranium cycle, you need to watch the contract market, not just the spot headline, and right now the signal is coming from the contract market. This is where the story gets more interesting. The spot price gets attention because it moves faster. But the long-term price matters more because it tells you whether utilities are willing to lock in future supply. And utilities do that because they have no choice. A nuclear reactor cannot simply run out of fuel. The U.S. Energy Information Administration says that in 2024, 91% of uranium delivered to U.S. reactor operators was purchased under long-term contracts. Only 9% came under spot contracts, and at the end of 2024, U.S. reactor owners and operators still reported 184 million pounds of unfilled uranium requirements over the 2024 to 2034 period. Meanwhile, UxC estimates that cumulative uncovered requirements worldwide are about 3.1 billion pounds to the end of 2045. That is the key point. Utilities are still recontracting, and that is why the long-term price matters so much. It is the planner's price. It is the financing price. And in uranium, it is the price that decides whether the next wave of supply actually gets built. The demand side is stronger than many investors still assume. First, the reactor pipeline is real. The IAEA's database now shows around 415 reactors in operation and 72 reactors under construction worldwide. Second, this is not only about new builds. A big part of uranium demand comes from extending the life of the existing reactor fleet. That matters because it means demand is not just a distant future story. A lot of it is already embedded in the current system. And third, electricity demand is getting a new leg from AI and data centers. The IEA projects that global data center electricity demand will more than double by 2030. So the demand case is not hype, it is a layered story. More reactors, longer reactor lives, and higher electricity demand in a world that still needs firm, reliable power. But the real heart of the thesis is not demand, it is supply. Uranium mining is highly concentrated. World Nuclear Association data shows that in 2024, Kazakhstan supplied about 39% of world mine output, Canada about 24%, and Namibia about 12%. Those three countries together accounted for roughly three-quarters of global mine production. That concentration matters because supply shocks can travel quickly. If Kazakhstan has chemical bottlenecks, if Canadian projects slip, or if Namibian operations run into water issues, the whole market feels it. And this is not a commodity where new supply appears quickly. Major uranium projects can take years to permit, finance, and build, which means price signals move faster than mine supply. There is also a second bottleneck that investors often forget. Mining is only the first step. Uranium still needs conversion, enrichment, and fuel fabrication before it reaches a reactor. So even when uranium itself is available, the broader fuel chain can stay tight. That is another reason utilities keep prioritizing security of supply. I think the market still gets one big thing wrong. A lot of investors assume that if uranium prices stay high, new supply will simply arrive and solve the deficit. That is only half true. Yes, high prices help, but the response time is slow, and in uranium, slow matters. Meanwhile, long-term demand expectations are still moving higher. That is why this story matters. The problem is not whether uranium is needed. The problem is whether enough investable supply can actually be delivered in time. Before going deeper, here's the short version. Cameco is the security of supply name. Kazatomprom is the low-cost scale name. Paladin is the operating leverage name. That is the framework for this whole video. Not hype, not buy anything nuclear, not a generic commodity trade, just one question. Which companies are best positioned to capture value in a tightening contract market? The first name is Cameco. If you want the cleanest Western uranium franchise, this is probably it. Cameco's core mining base sits in northern Saskatchewan, in the Athabasca Basin, which is one of the most important uranium regions in the world. Its two flagship producing assets are Cigar Lake and McArthur River. That geography matters, because in a market where buyers increasingly care about trusted supply, Saskatchewan is about as strategic and politically stable as uranium gets. At the company level, Cameco produced 21 million pounds in 2025 on a share basis, delivered 33 million pounds to customers, and ended the year with roughly 230 million pounds in long-term uranium commitments over the next 5 years. It also finished 2025 with around $1.2 billion in cash and short-term investments, against roughly about $1 billion of total debt. And Cameco is no longer just a miner, it owns 49% of Westinghouse. Westinghouse is one of the most important companies in the nuclear industry. It designs reactor technology and provides fuel, services, and equipment to utilities around the world. For Cameco, the investment goes beyond uranium mining. It's a way to expand deeper into the nuclear fuel cycle. That matters because it gives Cameco exposure beyond the mine gate. The company now participates not just in uranium production, but across a broader nuclear services and reactor ecosystem through Westinghouse. There is also a customer geography angle worth mentioning. Cameco's customer base is broadly diversified across Europe, the Americas, and Asia. That matters because strategic suppliers cannot depend on a single region. That is exactly what you want in a strategic supplier. It is not dependent on one region. It sells into the major nuclear demand centers across the Western world, and beyond. So the Cameco thesis is simple. This is not the highest beta uranium stock. It is the security of supply name, a contract-heavy, jurisdictionally strong, geographically relevant platform with a real downstream nuclear angle through Westinghouse. But if Cameco is the safe name, the more interesting question is this: where is the real asymmetry? My answer is the lowest cost giant. That brings us to Kazatomprom. Kazatomprom is the biggest uranium producer in the world, and the investment case starts with one simple fact: it is the lowest cost large-scale producer in the market. For 2025, Kazatomprom reported production of 67.18 million pounds. Its attributable C1 cash cost was $18.06 per pound. In simple terms, C1 cash cost is the direct cash cost of producing a pound of uranium before broader sustaining and corporate costs. That is why the figure matters. It tells you how much margin cushion the business has if uranium prices stay strong. And the reason Kazatomprom can operate so cheaply is its mining method. Most of its production uses ISR, or in situ recovery. Very simply, that means uranium is recovered underground by circulating solution through the ore body and pumping it back to the surface, instead of digging a conventional open pit or underground mine. It is a cheaper method, and it is one of the main reasons Kazakhstan dominates the industry. But there is also a catch. Kazatomprom's 2026 outlook is explicitly sensitive to sulfuric acid availability. That sounds like a small detail. It is not. In uranium, boring industrial inputs can become real supply bottlenecks very quickly. The sales distribution table adds another useful layer. Sales are heavily concentrated in China at 44%, followed by Russia at 12%, the United States at 11%, and Canada at 10%. That tells you two things. First, Kazatomprom is not just big in production, it is deeply embedded in the global fuel market. Second, its customer mix is much more tied to Asian demand flows than a Western producer like Cameco. This is the cost and scale name, the best pure operating leverage in the sector, but also the name where chemistry, logistics, and geopolitics matter the most. So now we have the Western cornerstone and the low-cost giant. The third name matters for a different reason. What if the cycle stays strong, but you want more upside per pound? That is where Paladin Energy comes in. Paladin is the highest torque name in this group. Its flagship asset, Langer Heinrich in Namibia, is a conventional open-pit uranium mine with a 17-year mine life, a conventional alkaline leach process, and strong infrastructure close to Walvis Bay. Paladin describes it as a strategic Tier 1 uranium asset. So this is not a conceptual future mine, it is a restarted asset that is now ramping, and that ramp is exactly why Paladin is interesting. For the 6 months ended December 2025, Paladin sold almost 2 million pounds at an average realized price of $70.50 per pound. Meanwhile, cost of production was $40.50 per pound. Revenue was $138.3 million. Gross profit was $26 million, but the company still reported a $6.6 million loss after tax, as ramp-up and expansion costs continued to flow through. At period end, it held $278.4 million of unrestricted cash and investments. That tells you what Paladin is. It is not the safest name. It is not the cheapest producer. It is the name with the most obvious operating leverage. If uranium prices stay high and the ramp continues to improve, and there is a second leg to the story. Through Patterson Lake in Canada, Paladin also has longer-dated development optionality. So Paladin gives you two things at once: near-term torque from Langer Heinrich and longer-term optionality from Canadian development. That is powerful in a bull market. It is also why the stock is the most speculative of the three. So let's reduce it. Why these three? Because each one maps to a different way of expressing the same uranium thesis. Cameco is the security of supply name, Kazatomprom is the cost and scale name, Paladin is the torque and optionality name. And together, they cover the three main ways this cycle can work: trusted contracted supply, low-cost leverage to a tighter market, and higher beta upside if prices stay firm and projects deliver. That is a much stronger framework than simply saying, uranium is bullish, buy miners. Now the risks. First, higher prices can eventually bring new supply. That is the obvious one. If prices stay strong for long enough, more projects get financed, and today's tight market becomes tomorrow's development pipeline. But the response is slow, not instant. Second, nuclear politics still matter. A major accident, a regulatory shock, or a policy reversal could damage sentiment and slow the broader build-out. Third, the uranium story is not only about mining. Conversion and enrichment constraints can shift where value sits in the fuel chain, even when mine supply is tight. And fourth, the stock-specific risks are real. Cameco can underperform if contract-linked pricing mutes spot upside. Kazatomprom carries country and chemical input risk. Paladin carries the most obvious operational and execution risk of all. So this is a strong structural story, but it is not a free lunch. So here's the thesis in one line. Uranium is a contract market with inelastic demand, rising long-term prices, and supply that cannot respond quickly. The market is tighter than it looks, because the real action is happening in long-term contracting, not just in the spot headline. Utilities still rely overwhelmingly on long-term contracts, and large future uncovered requirements remain in the system. That is why three names stand out. Cameco first, the strategic Western cornerstone; Kazatomprom second, the low-cost giant with the strongest pure margin leverage; Paladin third, the torque name if the cycle stays strong and execution holds. Not every uranium stock wins equally. These three give you three different ways to express the same structural imbalance. This is capital rotation. We look for the capital flows behind the headlines.